Hi, and welcome to session 3, which is pensions. A pension is very different than a 401k. Sometimes you'll work for an organization and they will offer a pension. For example, if you work for the government, they will offer you a pension, but other companies will offer you a 401k. And this session is specifically designed to talk about pension accounting. With a pension accounting fund, you can have either a contributory pension or a non-contributory pension, where the contributory portion of it says, in addition to my employer giving me money, I will also put in money to fund my pension. A non-contributory pension is when the employer just funds the pension for you. You don't have to put a dime in. A couple of terms that you're going to need to know about is vested benefits, which basically says, when am I entitled to my money that's in my pension fund? The vested benefit obligation is how much do I owe all of my employees at today's current salaries. The accumulated benefit obligation is how much do I owe all of my employees at current salaries. In total, what is my obligation to my employees? The projected benefit obligation, we're going to call PBO from here on out, is how much am I going to owe all of my employees down the road when they finally come time for them to retire. So they are at future salaries and not current salaries. You have a handout that is on the learning management system, and it will tell you what is included in your pensions. All 5 of these items are going to be included in your pension expense. 2 of the 5 items, though, are also included in OCI, other comprehensive income. So as we look at the components of what goes into pension expense, service costs are those costs that, because you worked for me this year, I'm going to fund money and give you money for your pension. Interest expense is if I had to borrow all of the money to pay the projected benefit obligation down the road, I'd have to go out to the bank, take out a loan, and they would charge me interest. So the interest component portion of it says I basically am going to have to pay interest if I had to borrow everything. The interesting thing about the interest expense, though, is that it's a calculation, and the formula is your beginning PBO for the year multiplied by the interest rate that the bank would charge you. Sometimes, though, we have to do an adjustment to the beginning balance of the PBO. In those scenarios, then you're going to take the adjusted PBO balance and multiply that times the interest rate to come up with the interest expense that you will be including in your pension expense. The third item is your actual or expected rate of return. So the company sends money over to the trust company for them to manage their funds for them, and the trust company will take those monies and invest it in an investment portfolio. Well, we want those investment portfolios to do well, earn back dividends and income, and when we sell them, hopefully have some realized gains that go with that. So when I do that, I can take those gains and have those actual returns actually be used so that I, as the corporation, don't have to send over as much to the trust company who's managing my funds. So you'll notice that the first 2, your service cost and your interest expense, they increased your pension expense because those funds that you would have had to give to your employees. Your actual return is going to decrease your pension expense because I don't have to send as much over for the trust company to work with, because I'm going to use my investments and let my investments work for me and use that to help fund the pension. In part 4, the amortization of the prior service cost. I start out my company, but I'm not ready to start giving you a pension yet because I don't know if I'm going to be around and make it through 5 years of this startup. So 5 years go by, now we're doing really great, and I say, geez, I'd like to start a pension, but I'd like to go back and reward those employees who have been with me for 5 years. So what we do is we figure out how much that value is of those 5 years of service, and GAAP comes along and says, you cannot expense it out immediately. Because if you think about it, if I'm a tiny company, it's no big deal. Small hit to net income. But if I'm a huge corporation, we could take millions and millions of dollars, expense it out immediately, and that would have a dramatic impact on your net income. So what they say is, we're going to take that amount of the prior service and we're going to amortize it over the remaining service life of my employees. So that will increase your pension expense. The last component is the amortization of the unrecognized gains and losses. So if you think about it, when I had actual gains and losses, they went into the third component of it. When I actually sold those investments, we took the money and helped it so that we didn't have to fund the pension as much. But as you realize from 2008, the market was extremely volatile. I could have huge swings in gains or losses in my investment portfolio. So GAAP came along and said, that's not really fair, because if we have huge losses, really more importantly than gains, it's not fair to the readers of my financial statements to not know that I may have this potential huge loss coming up. So they came up with something that's called the corridor approach. And basically, if you're within the corridor, everything's fine. We don't have to amortize any gains or losses. But the minute you move outside the corridor, then we're going to have to amortize those gains or losses, and they will hit pension expense. They will also be recorded as other comprehensive income, which will show up on the statement of retained earnings. So look very carefully at Part 5 and make sure that you understand that as we move through. What I'm going to do here for the remainder portion of our quick lecture introduction is to work through pension worksheet handout number 2. What I want to point out in terms of how do you understand this pension worksheet is that it has 7 columns. The far right 2 columns have nothing to do with the calculation of pension expense. They're what you call memorandum entries. I'm going to keep a running total of my present benefit obligation and the present running total of my plan assets, the amount of the investments that I have over at the trust company. So that means the first 5 columns are what we're going to use to calculate our pension expense. That means the summation of all those first 5 columns, your debits have to equal your credits. But the first 2 columns are going to be what's recorded in other comprehensive income, which means it not only hits on the income statement, it hits on that statement of retained earnings in that OCI. So we start out with the beginning balance, and if we need to make any adjustments, they will happen at the beginning of the year, and we will then come up with an adjusted beginning balance. Now I said if you have adjustments, you're going to have to use that adjusted PBO line item dollar amount to calculate your interest cost. So you'll notice that when we're calculating the interest expense, it must be 10%. I did not use the $800,000. I used the $950,000 to calculate that interest cost. So again, the service cost says you worked for me this year, debit to pension expense, credit to I owe you the money, the liability, and we're used to just seeing debits equal credits. Well, now we're also going to say, let's have this running total in my PBO column. Because you worked for me, I owe you additional money, which will increase my overall liability to you. When I have to go out and borrow all of the money, I have to pay interest back on it. So debit to pension expense, credit to the liability because I'm going to have to come up with those monies, and because I have to come up with the funds, it will increase my overall liability to you. We had said when we have those investments and they make money for us, we're going to take those funds and we're going to use them for our benefit. We said it will reduce your pension expense. So it will credit pension expense and it will reduce your liability. Therefore, you would be debiting this in the pension expense journal entry. And if you think about it, my investments made money. So they're not going to send the money back to the company. The trust company is going to keep the funds and they're going to buy more investments. So the value of your investment portfolio will increase because your investments made money. With the amortization of the prior service cost, we said we went back at the beginning of the year and we want to reward you for your prior year's service. And GAAP said you can't expense it all out. So we record in OCI the total amount of the value of your prior year's service, and in the current year, we will write off a small portion of that. It will increase your pension expense, and it will reduce the amount that I have in total that I will be writing off over the balance of the years. The company at the end of the year will send money to the trust company so that they can manage their fund. And so cash will go out the door by crediting it. It will also decrease your liability because I've sent the trust company my money. And if I send money to the trust company, they're going to take those funds and they're going to buy investments with them. So your overall assets will be increased by that amount. When it comes time to pay our retirees, though, the money doesn't come from the company. The company's already taken their funds and they have placed it with the trust company for them to buy investments. So the only way that I can actually pay my retirees is to liquidate investments, then take those monies and send it off to the retirees. So you'll notice that in the retiree benefits columns, we are actually reducing and liquidating investments, decreasing the plan assets, and we are decreasing our PBO. The PBO is a liability account. So I've paid you, I'm not going to pay you again, therefore I'm reducing my liability. This total for the current year will take your service cost all the way through the retiree benefits and it will add them up, and that's what you will put for this row. The important thing that you have to remember is you have to remember your debits and your credits. You just can't add all of the numbers. You have to say, are they positive, are they negative, and how will that impact this second to bottom row. Again, you have to remember that your debits equal your credits. So the first columns, they should balance out so that your debits equal your credits. There's always a way for us to double check if we've done something right. I like check figures. I like to know I'm right. I like to prove I'm right. And so accountants really like that component of it. So if you take a look at your final two columns and you take the minus 145 and the positive 129, that is actually a credit balance of $16,000. That credit balance has to equal the dollar amount that's shown in your net pension liability cell. And if it doesn't, you know you've done something wrong. When it comes to the very final row, the ending balance will be, depending upon whether you have an adjustment to your PBO, it will be the beginning balance plus the current year if there are no adjustments to the PBO. If there are adjustments to the PBO, then it will be your adjusted balance plus the current year to give you your final number. Again, first 5 columns, debits have to equal credits. In your final 2 columns, when you see what your balance is, this final balance must equal the final balance of your net pension liability account, and if it doesn't, you know you've done something wrong. If you've done something wrong, really what you should do is do the first addition and subtraction down the road to make sure that that's not where you've goofed up. If you're still not coming up with having your numbers balance out, then you're going to probably want to go row by row to see, did you record everything properly? What will be on the exam from session 3 is the one numerical problem that is going to be given to you. It will be a pension worksheet exactly like the items that are given to you in your handout in the learning management system. You will also have another problem that will ask you to calculate your post-retirement expense. Post-retirement expense is another fancy way of me saying your pension expense. So basically you're going to start out with your 5 items: service cost, interest cost, expected return on plan assets, your amortization of the unrecognized gain or losses. You do not have to calculate out a separate worksheet for that problem. I just literally want you to write down the 5 items, add them up, and give me your answer. Thank you.